Hello, everyone. This is for first-time buyers and anyone feeling rate locked in a 3 or 4% mortgage. On September 17th, the Fed cut the federal funds rate by 0.25% to a 4% target range, and its projections signaled 2 more cuts this year if the data allows. Now, here's the key. Mortgage rates do not directly follow the Fed's rate. They track longer-term bond yields, especially the 10-year Treasury, and a spread for mortgage risk and costs. That's why mortgage rates sometimes dip or hold or even rise after a Fed cut. So what's happening right now? Some trackers show that mortgage rates are easing to their lowest levels in months, helped by lower Treasury yields and the Fed's shift toward easing. Others note brief bumps up as markets reprice risk and uncertainty. Amazingly, both can be true in the short run because bond markets drive the outcome. If you're buying, here's the upside for you. A Fed pivot that's credible to markets can pull down long-term yields, and it can narrow mortgage spreads, which will nudge 30-year rates lower, even modestly. That makes payments more affordable, and it can bring a few more homes onto the market. If you're locked in, you know the story. Most homeowners like you hold mortgages below today's rates. That's a classic lock-in effect, and it keeps people from moving, and it keeps inventory tight. As rates edge down, some owners might finally cross their personal why move threshold, freeing up listings and giving move-up buyers options. Recent research and surveys show how powerful that lock-in effect has been. But we should stay intellectually honest and raise 2 caution flags. The Fed is not the boss of mortgages. If inflation surprises or bond investors demand more return, 10-year yields can rise, and mortgage rates can rise with them, even during a cutting cycle. Investment spreads matter. If mortgage-backed securities stay out of favor or risk premiums stay elevated, lenders may not pass the full benefit through to borrowers. Bottom line, optimistic version. This cut and guidance for more tilts the odds toward gradually better mortgage conditions into the end of the year, but it doesn't suggest that rates will fall dramatically. Still, for first-time buyers, that can be the difference between wait and go. For locked-in owners, it may open up a path to sell or buy or refi without blowing up their budget. So what should you do now? Get a fresh pre-approval and set rate alerts so that you can lock quickly on a dip in rates. Or price out multiple scenarios, buy now with a potential refinance later versus waiting for an extra quarter-point drop in a few months. If you're locked in with a low rate, run the math on move-up affordability under slightly lower rates. Inventory may improve as more owners do the same thing. I'm rooting for a slow, steady thaw. That's more inventory, slightly lower payments, fewer golden handcuffs. That's probably the most constructive path for housing from here, even if it might not be the most exciting.